Hey guys, it's Doug the Retirement Guy. Welcome back to the channel with all your monthly ETFs. Well, we got something brand new for you. This just come out, a targeted yield, brand new ETF from Cathie Wood, and it is advertising a 17.5% targeted yield. So I knew right off the bat, so many people were probably going to jump and look at this because of a 17.5% yield right off the bat, because I saw so much of it when Tap Alpha came out with theirs and hit the 17 points. A lot of people's attention are moving towards that. So I wanted to give you some insight of ARKY, the ARK Active Autocallable Income ETF, as what they're introducing. So grab your favorite mug, sit back, relax, and let's get ready to cover the targeted 17 yield. So disclosure, this presentation is for educational purposes only. It's not financial, legal, or tax advice. Past performances do not guarantee future results. ETF distributions can change over time. If you need a financial advisor, always contact a professional. Hey guys, I got an announcement for you. I finished this, something that's been on my brain to do. I'm excited about it, but we have a brand new book that I just wrote. Living on Dividends, the three bucket system. It explains the entire three bucket system, from the foundation fund to the income fund to the growth fund, how they all work together. It's very detailed across. It's really a quick read, maybe about 46, 47 page insight. It's got a little workbook inside of it to help you out. So I'm excited about it. It's one of these things that you put a lot of time and effort into it and you get excited. But there's multiple ways to get this. You can order it directly from Amazon, doing a Kindle. You can order the book directly from Amazon, or you can directly order it from our website and get it that way. And when you do, I'll sign it for you. Something unique. I've never done that before, but I'll sign it for you. Personal autographed book for you. So look for it. I'll leave a link down below. You can use the QR code, but I'll leave the link down below for you. Go right to all of our Living on Dividend apparel products and go from there. So let's go on. So ARKY, the Cathie Wood's new 17.5 income ETF. Would I use this thing in retirement? Well, we're going to talk about this one. And it is an autocallable. Now, we've covered autocallables before, and it's kind of like a new thing, but this is not your normal covered call ETF. So there's a lot of high targeted coupon with a conditional downside risk all built in together. So let's talk, what is our ARKY? And the primary thing, here's the first thing, is launched on August 19th of 2026. So it's, maybe a couple weeks old by the time the video is getting out here. It's probably only a couple weeks old. It's using the CBOE BZX exchange. Now, its advisor is ARK Investment Management. Okay. And that is the big package, and that's what Cathie is part of, is kind of created this. So the ARK Innovation Universe, what they're basically doing is they're creating about 20 to 50 different funds to create this universe. It's a volatile linked auto-callable. That's the structured note that they do. And then their current objective is to basically pay out monthly income on the funds. So the first ETF specifically designed around current income. So this thing is built income. I almost want to say this again. Income is designed for that. So ARK is attempt to turn some innovation stocks, which is your NASDAQ 100 stocks, the volatility of those funds, into monthly income rather than focus primarily on long-term capital appreciation. So the income objective is not guaranteed income. But what they're doing is they're moving away from growth side of things and creating some income for the retirees into this program. Now, the fund's basics. So beyond the traditional dividends that you would expect, ARKY is built around a structural exposure, not a basket of dividend-paying stocks. Right off the bat, their expense ratio is 0.85%. Personally, a little high. But $85 out of a $10,000 investment every year goes to the company to cover and maintain the operations of the package. Now, they're using that 20 to 50 single stock autocallable positions, individual positions that may reference companies in the ARK's innovation universe. At least 80% generally invested in securities and financial instruments designed to create exposure similar to the autocallable equity-linked notes. Ordinary income and dividend approach is not what they're looking to do. It's not a simple direct ownership of dividend collecting stocks. What they're doing here is a synthetic structure. Individual stocks doing synthetic ELN notes, then the auto-callable payoff terms, and that potential income. Okay, so it's a little bit more of a constructive and a little more, I'll call it a confusing setup that they're using. But they're giving you the premium exposure to synthetic equity-linked notes, ELNs, to create that income side of it. Now, how are they going to get a 17.5% targeted coupon, and how does it all work? Well, this Autocallable 101 is a hypothetical illustration of what would happen. Hypothetical stock starts at $100. The hypothetical coupon barrier, we're going to call this $55. So if the stock is above the barrier on the observation date, the contract may qualify for coupon, depending on its terms. So what we're saying here, as long as that price, the strike price, is basically above the barrier, the coupon may qualify, which is your coupon barrier paying out your distributions. Okay? So this is why, this is how they have set this all up. So why is volatility can create that high income? The premium has the source. ARKY seeks to capture a difference between implied volatility in option prices and the volatility that ultimately occurs in the underlying stocks. So let me break this down for you. The volatility innovation universe, the high growth technology, the AI, the biotechnology, the autonomous vehicles, you get the idea that it's a lot of high tech products. And there's more uncertainty. We don't know any of those. Will autonomous vehicles own the world and own the roads? Is the biotech going to do what we need? Is AI going to take over? There's a lot of uncertainties. So the expense options, the higher implied volatility can make options more expensive. So that premium opportunity, the potential volatility premium, can support the targeted income. So we're playing in a high, I'll put it my way, we're going to play in a high risk category that she's watching for and seeing, is this going to create the option prices, which are going to be a lot higher, which will generate more premiums, which will give you the income. That's why we're targeting. And remember that target is like a dartboard. We're throwing a dart trying to get 17.5 out of it. So this one, I call it the memory feature. It's missed and not guaranteed. This again goes back to the hypothetical example of a $100 starting price with a $55 barrier. So if you start off with a $100 price on the fund, and the barrier, let's say it drops 20%, you're down to an 80% pricing, which you're above the $55 barrier, which means the coupon potentially is going to pay out. Month 2, $70, you're above the barrier, potentially pays out. You hit $50, you're below the hypothetical barrier. The coupon may not pay. Okay? Month 4, if the barrier comes back up, the previous missed coupon may be recovered and you're back to paying. So recovery all depends on the stock's rebounding and its ability to do that. So this is not absolutely a guarantee that it happens. The exact payment and history is going to depend on what the contracts are actually written and how they're written. So there could be some times where you're going to miss payments on these accordingly. So an auto call and a reinvestment risk, the contract can end early. That 17.5 is a target, not a fixed long-term rate. So there's a calendar for observation date, which references the stock is above the call level or not. Early termination, they can eliminate those synthetic ELNs and terminate early whenever they achieve a certain number, position, or so on. The coupon is then paid out according to the contract terms, and the capital redeployed into a new autocallable contract, which then synthetic ELNs would be reversed and we start the whole process over. So the next autocallable may offer less than 17.5. The volatility may be declining, market conditions may change. The target coupon can change over time. So this is why we say this is not just a standard covered call ETF. There's a lot of moving parts to this. And remember, their goal is income as much as they possibly can. So the risk that we need to do is the maturity barrier and that magic floor. There's two different thresholds here. Neither is guaranteed on the floor. The coupon barrier. So they'll set this thing up. And I am using my hypothetical part of it. So let's say it's $100 point and their barrier is set at $55. May determine whether a coupon qualifies on the observation date or not. So as long as that is on observation date, it says it's at $70, it's above the barrier, everything's fine, pays out, goes on accordingly. If the maturity barrier is broke, let's say that fund is $40, that $55 point is broke. Well, then the maturity barrier loss can be real, okay? And that stock falls from $100 to $40. So $1 million underlying 50%, the fund could owe the counterpart approximately $500,000. So there's a lot of pieces of why this is not just the old-fashioned, I always called it the barrier. Once it gets to 55, we cancel it, we crush it, we're over with, start over. Now, there's some magical points that come into this as well. Diversification helps, but it also correlates, can rise. So that 20 to 50 positions can spread individual single stock risks across the board because you're going to have it in technology, AI, biotalk, robotics, a good solid, I'm going to call this all tech or all high level tech side of things, but it's a broad market stress and they're correlating into a bigger package of a risk. And this can rise, this can help rise it or bring it down depending on how the market goes. So ARKY, I want to show you the difference between a traditional covered call and what they're doing. Traditional covered call has the equity exposure, generally owns or obtains the equity exposure. If they're buying, like QQQI, they'll buy all of the funds and then buy indexes. GPIQ will buy the funds and then cover it, portion of what they own, they'll cover. So that creates the income of the options that they do. And the main trade-off typically is the upside potential. There is no there caps your upside on a lot of the funds. Okay. Well, what ARKY structure is going to try to do is it's going to use those individual stocks. It's then going to write the synthetics ELN notes across that, giving you that coupon barrier with call levels and maturity barriers. So they're going to be watching, and again, I'm putting it Doug's layman's way of talking about this, is it's going to give you the exposure that you're looking for through the synthetic structure of those individual stocks, not the entire NASDAQ 100. It's giving you the higher level high tech stuff. It's going to give you the contract features, which are coupon barriers, call levels, maturity barriers, and observation dates. So they're going to be watching these select dates of when, maybe the coupon will be called, maybe the barrier stays above, things are looking good, or maybe it just gets above a certain level and they cancel it out. The underlying universe, the volatility of the innovation companies and ARK's universe is another main piece. But the main trade-off is the condition of that downside exposure in exchange for a potential much larger targeted coupon gamble. So what they're trying to do is give you income with open and top end. There's no covered, no, that covered call, that stopping point, that they do. So, like I've always said, if you have a $50 fund and you put a call option at 52 and that stock goes to 54, you're only getting 52. Well, here, this is going to allow them to race higher across the board, creating more income, not just growth or potential growth. It's giving you more income potential. That's why we keep saying this is a targeted event. Now, ARKY versus ARKK, you already have them out there. They have the fund out there, but it's designed, ARKK is designed for growth. Okay, it's long-term appreciation. They didn't build anything into it for income. They did it all about growth of a fund. While this one's coming into it is all about income. So it's not replacing ARKK. It's almost like we have an apple and an orange, two different jobs, two different reasons, two different things to do. So it's like adding on to their portfolio that they have. So you got this ARKK for heavy long-term capital appreciation, which would basically be in your growth bucket. And now ARKY is going to be able to go into your income bucket for generating income across the board. So retirement income and tax reality. Well, first off, we are only working with hypothetical right now because a 17.5 target does not guarantee anything, doesn't say anything, doesn't prove anything, and they haven't made a single payment out. So, but what they're trying to do is get people interested into the fund at 17.5% is what their potential growth could be. The tax characteristics, again, brand new fund, but they've already established what they say that they're going to do, which is ordinary income, short-term capital gains, long-term capital gains. There are certain derivatives that may qualify for the 1256 treatment, which is that 60-40 long-term, short-term capital gain advancements. And they're also talking about having the return of capital being a part of this. So until we get the hardcore facts, which is going to take time to get, exactly how they're recording it, what they're reporting, you got to be careful with this in a brokerage type account. But we look at the hypothetical side, that 17.5 could be a very strong net income. If $100,000 was invested to this, you're looking at about $1,400 a month income if everything's working accordingly. So this is a big game. This is a big potential thing. So when we look at this into the 3-bucket placement, well, right off the bat, ARKY, to me, would be a very small, very monitored satellite piece of my income. And I'll tell you why, because this is not one of promoting a fund or telling you, hey, this is just something new that's out there that I know a lot of people are going to jump onto immediately and say, whoa, what's this 17.5? But it's so new, you don't know where it needs to be or what's going to happen with it. So these things I want to make sure people understand. First, you want to see distribution. You want to see the consistency coming through. We need to watch the NAV stability. Is the NAV coming around? We need to watch the total returns. Then we also need to watch the bear market performance. What's happened when these stocks start getting stress and what pushes to the barrier across the board. So my final scorecard of this one, I really wasn't doing it to relate to say, hey, this is a strong investment or not. But what it put it to me as is I basically said, I'm very interested, but I'm not ready to call it a core retirement ETF. I'm not actually even ready to call it a satellite piece. Because what I like so far is a 17.5% targeted coupon and the monthly income objective that's potentially out there. And I like autocallables, and I understand autocallables a lot with the barriers and how they're going to play and so on. But with that open end to go up, with the barrier helpful to see what's going down, I like those. I like that she's used the 25 to 50 individual positions. I like that memory feature. I like the active management that this thing's going to have. It's another NASDAQ exposure. And it gives you that daily ETF liquidity. But here, let's go to the negatives. It's a brand new fund. You know my rule. If you've watched long enough, you will know my rule. I won't jump into anything between 6 to 12 months before I'll even consider any of it. 6 months, you better be proving everything strong. And we're not there, we're just brand new. So there's meaningful performance history. There is none. There is no history I can go by saying this is doing great. All I have is someone who has a good track record, but and is telling me a target that they're looking for. There is no income contingent. I don't see anything else that if this thing doesn't perform, there is no dividends coming in. There's no interest coming in. You're all in at one time. Now it has about $2.5 million of assets, so that's another avenue. Assets under management. We want to see that thing grow. There are going to be people, there are going to be institutions that are going to bite into this thing. They're going to buy it to start growing it, and we'll see how that thing goes. But it's a complicated derivative. If you don't understand this, it's a complicated piece. It's very hard to explain. And the counterpart risks and that leverage risk, that potential that they're going to have, it's just a lot of things I tell people. Hold your horses. Don't just jump at the 17.5. Don't go to yield chasing. Sit back, relax, but keep this on your radar. This is really what the video is for, is something to put on your radar, put on your scope, and maybe down the road here, 12 months down the road, we'll have another video explaining exactly how to use it, where to use it, and where to go from it. Hey guys, it's Doug the Retirement Guy. Let me know your comments down below. Do you like this idea? Do you understand it all? And do you see what they're trying to do? Love to hear your input. Love to see if anyone's bought this already. Love to hear it from down the road. Let me know. We'll catch you at the next video.